Imagine a hit rock band, right? They're right in the middle of this massive, sold-out global stadium tour.
Okay.
And suddenly, they just drop their guitars, kick over the drum kit, and announce to a very confused audience that they are now a classical symphony.
Oh,
Yeah. They're basically willing to watch the crowds thin out and, the record sales totally plummet because they have become entirely obsessed with violins.
that is quite the image.
Well, it's exactly what we are watching happen with Tesla right now in the early months of 2026. Welcome to the deep dive, by the way. We're so glad you're here with us. Today, our mission is to unpack this really fascinating, highly detailed document.
Right, the Tesla SWOT Analysis 2026 from SWOT Pal.
Exactly. Because what they are attempting right now has to be the most ambitious, high-wire corporate pivot in modern history. I mean, they don't just want to sell you a car anymore. They are actively mutating into an autonomous mobility and robotics platform.
They really are. And looking at this SWOT analysis, which breaks down their strength, weaknesses, opportunities, and threats, you get this perfect high-definition snapshot of a company pulling itself in multiple, entirely contradictory directions.
Completely contradictory.
Yeah. On one hand, you have the promise of this utopian trillion-dollar autonomous future. But then on the other hand, you have a very messy, bleeding present-day reality on the actual factory floor.
Okay, let's unpack this. Because the contrast between that autonomous future and what is actually happening on the sales floor right now is, well, it's staggering.
It really is.
Let's just look at the hard numbers for a second. 2025 marked their second consecutive year of delivery declines. They dropped down to 1.64 million units.
Right.
For a company that trained Wall Street to expect like 50% annual growth forever, shrinking for 2 years straight is a massive red flag.
Oh, absolutely.
But the volume drop isn't even the scariest part, right?
No, it's the margins. Their automotive gross margins plummeted from 28% back in 2022 down to just 18% in the fourth quarter of 2025.
18%. Wow.
Yeah. And to keep even that lower volume moving, they had to slash prices on the Model 3 and Model Y. I think it was 6 different times last year.
6 times, which just screams that those core vehicles are aging out.
Exactly. I mean, the Model 3 and Model Y are essentially the automotive equivalent of an iPhone 12 at this point.
That's a great way to put it.
They're great products, sure, but the market is totally saturated and the fundamental design hasn't changed. So to keep demand artificially inflated, you have to compress your own profit margins.
Right.
But if we look at the strategy here, holding on to that traditional automotive model just isn't the goal anymore. The symphony they are building, to use your analogy, is the Robotaxi market.
Right, the Robotaxis.
We're talking about a total addressable market that's projected to hit $4.7 trillion by 2030.
Okay, wait, I need to stop you there, because $4.7 trillion is a number so large it just loses all meaning.
It is massive, yes.
How does a car company find nearly $5 trillion?
Well, by fundamentally changing what a car even is. That $4.7 trillion doesn't come from selling more sedans to families.
Right.
It comes from entirely replacing personal car ownership. It means completely absorbing the global rideshare market, so Uber and Lyft, and taking over last-mile delivery logistics.
Which is a complete paradigm shift.
Exactly. And to capture that, Tesla made this drastic, really aggressive choice.
Yeah.
They completely canceled their long-promised $25,000 compact electric vehicle.
Yep, the cheap EV is gone.
Gone. Instead, they took all that engineering capital and went all in on the CyberCab. Production is actually starting this April at Gigafactory, Texas, and they're targeting a $30,000 retail price by 2027.
See, I have to push back on this.
Okay.
If your core vehicle sales are dropping, and like we said, 1.64 million is a massive step back, and you haven't had a truly new high-volume vehicle platform since the, frankly, pretty troubled 2023 Cybertruck.
Right, the Cybertruck rollout was rough.
Very rough. So isn't abandoning the cheap entry-level EV a potentially fatal gamble? I mean, dealerships and consumers have been begging for an affordable electric car. You are leaving a massive hole in your lineup right when you need cash flow the most to fund all these robotic ambitions.
I get that.
Yeah.
And it does look like a massive gamble if you evaluate them purely as a metal-bending car company.
Which they say they aren't.
Right. But if you look at the underlying technology, building a traditional low-margin $25,000 car is actually the bigger risk.
Really? How so?
Because it's a race to the bottom against foreign competitors who just have cheaper labor and cheaper materials. Tesla's actual moat, the thing literally no one else has, is their full self-driving technology, FSD version 14.
Okay.
They have amassed an almost unfathomable 6.9 billion miles of real-world driving data.
Okay, let's break down why that specific number matters for you listening, because 6.9 billion is a lot, but why does it give them such an advantage over, say, a legacy automaker who just decides to write some self-driving code tomorrow?
Because you can't just write code for reality. The real world is way too messy.
Right.
You can't just write a line of code that tells a car what to do when a mattress falls off a truck in front of it, while a pedestrian in a chicken suit crosses the road on a skateboard.
A chicken suit on a skateboard.
Right.
The weird stuff.
Exactly. Those are called edge cases. The only way a computer learns to navigate that chaos is through pattern recognition, which requires a massive, almost gluttonous amount of video data.
Just feeding the machine.
Exactly. Those 6.9 billion miles feed directly into Tesla's neural networks. It's an end-to-end system where the car simply watches human drivers react millions of times until the artificial intelligence builds an actual intuition for driving.
And it's not just the software, right? Because they just won Motor Trend's 2026 Best Tech Driver Assistance Award.
Yes, they did.
And the source notes, they won that because they have total vertical integration. And when we say vertical integration here, we mean Tesla isn't just buying off-the-shelf microchips from some third party and trying to make them play nice with generic cameras.
No, they do it all in-house.
Right. They are designing the exact custom silicon that processes the specific video feeds from their own car cameras. So the software and hardware communicate with zero friction.
And what's fascinating here is that while this vertical integration is a massive technical triumph, it has actually created a profound vulnerability.
Oh, the regulatory wall.
Exactly. And that brings us to the National Highway Traffic Safety Administration, or NHTSA.
Right.
On March 19th, 2026, NHTSA escalated its investigation into this very FSD system, and the probe is aggressively focusing on safety defects in reduced visibility conditions.
Specifically, fog and glaring sun.
Yes.
Which raises the obvious question for you, listening to this deep dive. If they have 6.9 billion miles of data, literally more than anyone else on Earth, how are things as common as fog or a bright sunrise still triggering federal investigations? What does this mean for unsupervised FSD approval?
It comes down to the hardware architecture they chose. Relying purely on cameras in heavy fog is it's like trying to fly an airplane by only looking out the windshield. It doesn't matter how smart the pilot is if they literally cannot see.
Because the lens is just blocked by the fog.
Exactly. Other autonomous companies use radar or LiDAR, which acts like an instrument panel. It bounces lasers or radio waves through the fog so they can see the physical shape of the world, totally regardless of weather.
But Tesla didn't do that.
No, Tesla bet everything on a vision-only approach, just cameras. So regulators are essentially asking, hey, what happens when the camera lens gets blinded?
And this isn't just a minor regulatory speed bump, is it?
Not at all. The entire valuation of this company rests on a single word, unsupervised.
Unsupervised.
Right now, their Robotaxi testing operates with human safety drivers ready to take the wheel. But if you want to tap into that $4.7 trillion market we talked about, these cars have to operate completely alone.
Makes sense.
If this NHTSA probe leads to a formal recall or, software restrictions in bad weather, this entire autonomous timeline could slip by years.
And if that happens?
If that timeline slips even 2 to 3 years, the SWOT analysis warns of a catastrophic valuation reset.
Wow.
Because without immediate, unsupervised FSD, Wall Street will just stop treating them like a high-tech robotics platform. They'll start pricing them like a traditional car company with shrinking margins and aging products.
A catastrophic valuation reset. I mean, that is the kind of phrase that keeps executives awake at night.
Absolutely.
But beyond the cutting-edge software and the federal probes, there are very physical, very immediate roadblocks dragging them down right now. Let's look at the manufacturing reality.
Right, the factory floor.
Well, their factories in Shanghai and Fremont are basically running like well-oiled machines. Berlin and Texas are just choking on production bottlenecks.
Yeah.
Take the Cybertruck. In 2025, production fell 40% below their internal targets. 40%.
And that isn't just a scheduling error. It's really a physics problem.
How do you mean?
Well, they decided to build the Cybertruck out of cold-rolled stainless steel, which is notoriously difficult to bend and assemble with any precision.
Right, the panel gaps were a big meme for a while.
Exactly. And you combine that with a completely new 48-volt electrical architecture inside the truck, and the manufacturing complexity just spikes exponentially. When a factory has to slow down the whole assembly line to fix complex, novel engineering problems, you burn cash and you miss delivery targets.
Which bleeds directly into the customer experience because Consumer Reports dropped Tesla's reliability ranking to below average in 2025.
Yeah, that hurts.
And we are seeing service center wait times stretching into weeks in major markets. I mean, in the early days, early adopters forgave a few panel gaps or long service waits because the tech was so revolutionary.
They were just happy to have the car.
Exactly. But now competitors are offering highly refined electric vehicles backed by traditional established dealer networks. Tesla's minimalist service model is rapidly turning from a quirky feature into a massive liability.
It is. And this raises an important question about public perception, which is also currently taking a severe hit. We really have to look at the specific social headwinds surrounding Elon Musk's involvement with the Department of Government Efficiency, or DOGE.
Okay, yes, let's touch on this. And before we do, just to be perfectly clear for you listening, both of us are entirely neutral regarding the political stances involved here. We are just reporting the facts from the source material.
Yes, strictly neutral. We are analyzing this purely through a business lens to see how political polarization is directly impacting consumer purchase decisions. We aren't endorsing or condemning the politics at all.
Right. So looking at the source, the friction is already in the market. Even though Musk stated he wouldn't do DOGE again, the damage seems tangible.
Very tangible.
We're seeing organized European boycotts, instances of actual car burnings, and a sharp drop in brand favorability among key demographics who, frankly, were previously the core buyers of electric vehicles.
Right. From a strategic standpoint, it's a textbook example of an external variable interfering with core business mechanics.
Yeah.
When the public profile of a CEO causes a measurable spike in customer churn, and you combine that friction with an aging Model 3 and Model Y lineup, you create a perfect storm. It becomes incredibly difficult to move metal in Western markets because a portion of your consumer base is now making purchase decisions based on socio-political alignment rather than just vehicle specs.
It really paints a picture of a company absolutely besieged. You've got federal regulators investigating their crown jewel technology, physical manufacturing bottlenecks on their newest truck, massive delivery drops, and organized boycotts hitting their brand reputation.
It's a lot.
It is. But here's where it gets really interesting.
Yep.
Just when you think the story is purely about a giant stumbling, the source material reveals two massive, unsung life rafts that are actively keeping this entire operation afloat.
The hidden engines of the balance sheet.
Exactly. The first one is China. Despite everything we just talked about regarding Western market struggles, in January and February of 2026, China made Tesla vehicle sales surge by 35%.
35% is a staggering jump in the world's largest EV market.
Right. The refreshed Model Y is just a massive hit over there. What this tells us is that the brand damage and the political headwinds are highly localized to the West. In Asia, the brand is still functioning as a premium, highly desired tech product.
Which buys them precious time. And that brings us to the second, and perhaps most critical, life raft.
Which is?
Energy storage.
Oh, yeah.
While the automotive press obsesses over car deliveries and factory bottlenecks, Tesla's energy storage deployments quietly grew by an astonishing 140% year-over-year in the fourth quarter of 2025.
Okay, 140% growth for a physical hardware product is mind-bending. But let's explain what we actually mean by energy storage, because we aren't talking about the battery sitting in the floor of your sedan.
No, not at all.
We are talking about Megapacks.
Exactly. A Megapack is essentially a massive shipping container-sized power plant. Utilities buy these things by the dozen to store solar and wind energy generated during the day, and then they discharge that power back into the grid at night or during peak demand.
So they're effectively replacing traditional, highly polluting natural gas peaker plants.
Precisely. And the utility demand for these Megapacks is so ferocious right now that Tesla's backlog extends all the way to 2027.
That's incredible. And the economics of this are the real story here. Remember how we said their car margins dropped to 18%?
Yep.
Well, these Megapacks boast massive 30 to 40% profit margins.
It's huge.
It's like going to a famous burger joint, right? And you realize they're actually struggling to sell burgers lately, but they're making all their profit by secretly selling incredibly high-end coffee out the back door.
That's a great analogy.
The side hustle is funding the main business. The projections show this energy division could become a $50 billion business by 2028. That would represent over 20% of their total revenue.
It is the ultimate high-margin hedge. It acts as a financial shock absorber against all those automotive and regulatory headwinds we discussed.
Definitely.
But here is the critical tension. Even with the Chinese market booming and Megapacks basically printing cash, Tesla is still racing against a ticking clock.
Because of the competition.
Exactly. Because while they are internally focused on pivoting to robotaxis and scaling these grid batteries, their competitors are aggressively eating their traditional market share today.
Let's talk about the sheer scale of the threat coming from China, specifically BYD. In 2025, BYD sold 3.2 million electric vehicles.
Wow.
That is nearly double Tesla's global volume. And BYD isn't just matching Tesla's tech, they are undercutting Tesla's prices by 30 to 40%. How does a company sell a technologically competitive car for 40% less without just going bankrupt?
It's about total, relentless vertical integration of the raw materials. BYD didn't start as a car company. They started as a battery company.
Oh, really?
Yeah. They own the entire supply chain. They have direct stakes in lithium mines. They refine the materials themselves. They build the battery cells, and then they build the car around it.
So they control everything from the dirt to the driveway.
Exactly. Tesla builds their own chips and software, sure. But BYD fundamentally controls the chemistry and the raw earth required to build EVs. That allows them to slash prices to a point where traditional Western automakers simply cannot compete on margin.
And then you combine that international onslaught with a severe domestic slowdown because total U.S. auto sales fell 17% in January 2026.
That's a huge drop.
And electric vehicles took the brunt of that hit. Consumers are dealing with subsidy anxiety, wondering if federal EV tax credits will even survive. And there's still ongoing hesitation about public charging infrastructure.
Right.
When the total pie shrinks and BYD is taking a bigger slice of what's left, Tesla's sales declines start looking less like a temporary dip and more like permanent market saturation.
Which puts an immense amount of pressure on the immediate horizon. I mean, all eyes in the financial world are fixed on the upcoming Q1 2026 earnings call on April 28.
That's going to be a big one.
Wall Street is looking for proof. They need to see that the high margins from those megapacks and the volume from China can adequately plug the hole left by shrinking Western car sales and the looming NHTSA probe.
Not to mention, their product roadmap seems incredibly stretched right now. The long-awaited Roadster unveil has been pushed back yet again to late April.
Right.
Which kind of signals that their top engineering talent is entirely consumed by the CyberCab and dealing with that FSD probe. We are seeing incremental software updates like version 2026.8 just rolled out with features like comfort braking and slightly better blind spot monitoring.
Yeah.
But let's be honest, slightly smoother braking isn't the trillion-dollar moonshot that investors are paying for.
No, it is not.
Yeah.
But if we connect this to the bigger picture, Tesla still has several massive paradigm-shifting wildcards in play. Well, take the Optimus humanoid robot. The total addressable market for a robot that can replace human physical labor in manufacturing or logistics completely dwarfs the entire global automotive industry.
That's true.
If Tesla captures even 5% of that vision, the revenue potential is practically infinite.
And there's the Tesla Semi, which is finally expected to really scale production in 2026. That taps into an $800 billion global trucking market.
Exactly.
We already have the data from the early PepsiCo deployments showing a 70% reduction in operating costs compared to traditional diesel trucks. A 70% cost reduction in logistics is the kind of math that forces entire industries to adopt your product overnight.
It's undeniable.
Plus, if they do solve unsupervised FSD, they don't just have to put it in their own cars. They could license that software to legacy automakers who are hopelessly behind on AI. They could literally turn Tesla into the Microsoft Windows of the automotive world.
Precisely. They are attempting to thread an impossibly tight needle here. They have to keep the traditional factory lights on by selling high-margin energy storage and aggressively pushing the Model Y in China.
Right.
They need that specific cash flow to survive this transition phase, just long enough to satisfy federal regulators, prove that vision-only autonomy actually works in the fog, and start rolling autonomous cybercabs out of Texas.
So what does this all mean? Why should you, listening right now, care about a deep dive into the 2026 state of this company? Because what we are watching isn't just about how many cars move off a lot in California.
No, not at all.
This is the ultimate real-time case study in extreme corporate reinvention. It's a masterclass in how even the most insurmountable technological head starts like hoarding 6.9 billion miles of driving data and designing custom silicon can still violently collide with the messy realities of physics, federal regulation, political polarization, and brutal global price wars.
Yep.
They are trying to turn a rock band into a symphony, and they're trying to do it while the stage they're standing on is actively catching fire.
It is a profound and risky transition. And looking at all this data, it leaves us with a truly fascinating, almost philosophical shift to consider.
What's that?
Well, if Tesla actually succeeds in this trillion-dollar pivot, if they placate the regulators, license out their artificial intelligence, and flood our cities with millions of perfectly networked autonomous cybercabs, what happens to the psychology of human drivers?
Oh, wow.
Once our roads are dominated by machines that communicate flawlessly with one another in milliseconds, never get tired, and never get distracted by a sunset, does driving a car yourself eventually transition from a mundane daily necessity into a highly dangerous, socially unacceptable, and ultimately outdated luxury?
A dangerous, outdated luxury. Imagine having to explain to your grandkids that we used to steer metal boxes down the highway at 70 miles an hour using only our hands and eyes.
It's wild to think about.
That is a wild thought to leave on. Thank you so much for joining us on this deep dive. Keep questioning the world around you, and we will catch you next time.